The pain every trader feels. Imagine this. You analyze the chart carefully. You mark your support and resistance levels. You place your trade with confidence. And of course, you place a stop loss because you're a disciplined trader. But then something strange happens. Price slowly moves toward your stop loss, touches it, triggers it, and immediately reverses in your original direction. The market goes exactly where you predicted, but you're already out of the trade. And the worst part? It keeps happening again, and again, and again. At this point, you start thinking, are brokers hunting my stop loss? Is the market manipulating me? Why does price always hit my stop loss? But the truth is much deeper than that. Your stop loss isn't being hunted randomly. In most cases, it's being hunted because it's exactly where everyone else places it. And today, we're going to break down why this happens and how smart traders avoid it. The liquidity trap. To understand stop loss hunting, you first need to understand one concept: liquidity. In financial markets, large institutions, banks, hedge funds, and market makers cannot enter or exit trades without liquidity. They need huge amounts of buy and sell orders. And where do those orders exist? Right where retail traders place their stop losses. Think about it. Most traders put their stop loss just below support, just above resistance, above swing highs, below swing lows, which means thousands of traders have stop losses in the exact same areas. Those levels become liquidity pools. And smart money knows it. The classic stop loss sweep. Here's what usually happens. Price approaches a key support level. Retail traders see support and start buying. They place their stop losses slightly below the support. Now the market sees something very interesting. A huge cluster of stop losses sitting just below that level. So what happens? Price quickly spikes down, triggers those stop losses, collects the liquidity, and then immediately moves back up. To the retail trader, it feels like manipulation. But in reality, it's simply liquidity being taken from obvious levels. The problem with textbook trading. Most traders learn trading from the same sources: YouTube videos, trading courses, technical analysis books. And those sources teach the same rules. Place stop loss below support. Place stop loss above resistance. But here's the problem. If millions of traders are taught the same thing, they will place their stop losses in the same places, which makes those areas predictable. And in trading, predictable behavior becomes easy liquidity. That's why markets constantly sweep obvious levels before moving in the real direction. Tight stop loss syndrome. Another major reason your stop loss keeps getting hit is placing stops too tight. Markets do not move in straight lines. They move in waves. They expand, retrace, and shake out weak hands. If your stop loss is too close to your entry, even normal market fluctuations will take you out. Many traders risk only a few points because they want a high reward to risk ratio. But the market doesn't care about your ratio. It moves based on structure and liquidity. If your stop loss is inside normal volatility, it will almost always get hit. Trading right at the level. This is another mistake beginners make. They enter trades exactly at support or resistance. For example, price reaches support. You instantly buy. But professional traders often wait for something different. They wait for the liquidity sweep first. In other words, price often needs to go slightly below support to trigger stop losses before reversing. So if you enter exactly at the level, you are often entering before the real move begins. Emotional stop loss placement. Sometimes the problem isn't the market, it's your psychology. Many traders place stop losses based on fear rather than logic. They think, I don't want to lose too much. So they place a very tight stop. But a stop loss should never be based on emotion. It should be based on market structure. Ask yourself one simple question. At what price would my trade idea actually become invalid? That is where your stop loss belongs, not where you feel comfortable. How smart traders avoid stop hunts. Professional traders approach stop losses very differently. Instead of placing stops at obvious levels, they think about where the majority of traders will place theirs. Then they place their stop loss beyond that area. They also wait for confirmation. For example, instead of buying exactly at support, they wait for a liquidity sweep, a strong rejection, a structure shift. This way they enter after weak traders have already been shaken out. The reality of stop loss hunting. Here's the truth most traders don't want to hear. Stop loss hunting is not personal. The market is not targeting you, but it is targeting liquidity. And if your stop loss sits in the same place as thousands of other traders, then yes, it will probably get taken. The key to surviving the market is simple. Stop thinking like the crowd. Start thinking about where the crowd is wrong. Think like smart money. If your stop loss keeps getting hunted, it doesn't mean your analysis is bad. It usually means your execution is too obvious. The market rewards traders who think differently. So the next time you place a stop loss, don't ask, "Where should I hide my risk?" Ask instead, "Where will most traders put their stop loss?" Because that is exactly where the market will go first. And the traders who understand this are the ones who stay in the trade when the real move begins.